Good afternoon. Welcome to our first webinar of the year. This year, AI Insights webinar series will include ongoing performance updates and market insights on private placements, alternative mutual funds, non-traded REITs, interval funds, and BDCs. Topics will also include those relevant to the current events that impact the alternative investment marketplace. We'll have a Reg BI webinar coming soon. Watch your email for our monthly event update, or you can visit AIinsight.com to register for our webinars. We'll also have a podcast called Alt Insights, which covers the latest alternative investment trends we're seeing. You can find it on our website or subscribe on Podbean or Spotify. I'd like to introduce Mike Kell, Senior Vice President of Program Management and Business Development. Mike?
Hey, Jen, thank you very much. And first off, obviously, I want to just thank everybody for taking a little bit of their time out of the day to join us and talk about really what we've seen in the private placement marketplace throughout 2019. And really at a high level from an industry perspective, but then obviously at a granular level within AI Insight. Really, the basis for the discussion is around the industry reporting functionality within the platform. I think many people on the webinar today have access to this. If you do not, well, first off, you'll be able to find out if you do have access. If you go to your dashboard, you log in, and as you can see on the screen here, the different icons across the top, you have the reports and logs icon at the very top. If you click that, that's where this drop down comes up, and you can see bottom right circled in red. Ultimately, within financial performance reporting, that top left link there, industry reports. You'll see right there if you're subscribed. If you're not subscribed, it'll say subscribe now. You could certainly have that option. If you are, you click industry reports, and then you can go in and ultimately access these reports. It's important to know it's a premium service. We have coverage on REITs, BDCs, interval funds, alternative mutual funds, and private placements. On the REITs, BDCs, the 33 Act filers, we do those 4 times a year. The interval funds, alternative mutual funds, it's twice a year because they're semi-annual reports on that side, on the 40 Act side. But on the private placement side of things, we report on a monthly basis. So we do this 12 times a year. Obviously, the discussion today, we'll touch a little bit about what we've seen in December, but really the majority of the discussion will be around, what did we see for year-end 2019. And I think it's important to understand that, as we go through this, there's so much information. We really have a short period of time, so we're not going to have a formal Q&A at the end, but you'll have our contact information at the end. I couldn't ask, we get excited when we get the calls, the inquiries, the requests for more information. So when you do see at the end that contact information, feel free to reach out. We're always happy to have a discussion and add any type of clarity that we can, because as you can imagine, there's only so much we can touch on in a short period of time. Kind of see just a rough agenda that we'll go through today. We'll kick off with overall private placement trends from an industry perspective, and then we'll go in and transition there from what we've seen here at AI Insight, and then we'll touch on each of there you can see the strategies on the screen or categories. We'll touch on each of those as well. But first, we'll go into the overall private placement trends. And ultimately, we'll start with on this slide here, really is something that we're all aware of over time. You can see that, and this looks at kind of the public markets, but you can see that the listed domestic companies, so publicly listed companies, has gone down. We're about at half the number, just over 4,000, at the year-end 2019. As compared to the height, I think in the mid-90s, you're really just over 8,000. So really half the number of public companies. You can see total market cap of the companies in trillions. What's that show? I think in 2018, it's give or take $30 trillion in market cap. So a lot of money in a small number of companies, relatively speaking. On the next slide, what we'll talk about, and I'm just kind of setting the stage that the public markets are shrinking as far as the number of companies, although it has steadied. It's really a small number of companies, but the market cap is increasing. There's a lot of money in a small number of companies. In the private placement side of things, what you see a couple of very high-level charts. It's really focused on real estate, which obviously many of you are likely aware that real estate is one of the single biggest buckets of alternative assets. And this just shows, without getting into the details of the charts, that ultimately it's a growth in the number of funds, growth in the number of deals, as well as the amount of capital that are flowing into those deals. Something that's interesting that you see if you look at the larger spectrum across the globe, ultimately, because these are global values, is the fact that although we are seeing a greater number of deals, we are seeing a greater number of funds come out, you're also seeing a concentration in those larger sponsors. So those large institutional names, I think we can all relate to what we're seeing really in the IBD, REA space, some of those household names that we're seeing raising a substantial portion of the capital. And I think we're also seeing that across the globe in these types of deals as well. In the next slide, ultimately, it's kind of the increase in AUM, and you can attribute that to two things. Obviously, as you can imagine, AUM, you have the capital appreciation side of it, but you also have the capital flows. There's other charts. So the SEC did a recent study, or they published it ultimately in 2018, but the data only ran through 2017, so I didn't want to put that out there. But if anybody's interested, feel free to get in touch with me after the call. But ultimately what it shows is kind of exactly what you're seeing on the screen here in the next couple of slides, where the story is, greater than 70% of all new offerings in any individual year are private placements, and of those, and that continues to grow, where the public markets are continuing to shrink. And even year-end 2017, $4.5 trillion flowed into public and private deals just in that 1 year alone, in 2017 alone, and greater than 70% of that capital flow was actually in the private markets. So on the next slide, ultimately what we'll do is show that, when we look at that globally, that's what we're seeing. And that takes into consideration not just retail money, but obviously, as you can imagine, a lot of institutional money as well from different channels. But what you see on the screen here is that same story plays out within AI Insight in the programs that we have that are typically a lot of those that are retail focused in nature, and those that the independent broker dealers are dealing with, the registered investment advisors channel. Those are the funds where those funds are flowing to. And you can see we had a record year in 2019. You can see the orange there are the total number of new private placement programs that we added to the platform. And the blue is the total number of new public programs we've added per year. Again, record year last year, but you can see, even from our perspective, that blue sleeve is shrinking. So net new programs added on a public basis is shrinking, and that's what we're seeing at AI Insight. Whereas the orange, the net increase there, obviously is expanding. So as a percent of overall programs that we're seeing coming onto the platform, they're private in nature. One caveat that I would like to make to that is the fact that we've also, from an industry perspective, seen a shift from the historic life cycle public non-traded REITs, where they raise their capital, they'd stop, they'd operate, and then they would liquidate. And now really you're seeing fewer funds, but they're perpetual in nature, so they're going on. And that's obviously attributing to the shrink in the total number of net new programs that we're seeing. We'll go into this more as far as kind of the makeup of that orange sleeve, where we're seeing the actual deal flow, but just at a high level, 1031s have been significant contributors to that. And then new in 2019, the Opportunity Zone funds as well, which we'll drill down to in just a second. But good things from our perspective as far as the funds flowing in. Now this is kind of an interesting chart here, and really what it focuses on. So the prior slide really showed the makeup of all new programs added to our platform, both public and private. What this is ultimately net private programs at year end. So as many of you are familiar with our platform and alternative investments in general, a lot of times they come out in some, if you think of like a 1031 exchange, I mean, it could literally be out for a month and fully raise its capital and close out. So what this reflects, this graph, is the growth in overall net open programs at the year end in the platform. So we have a lot of programs that we add in a given year, and we have a number of those that close out to new capital. But this shows that ultimately the menu of open offerings currently raising capital, it continues to grow. And then the two other points is, as you would expect, the target raise does as well, which should really reflect the opportunity that these managers are seeing in the market. And capital, you see kind of a slight decline there. It's a little bit misleading because what you don't, if we were to include kind of on a cumulative basis those programs that closed, then that capital raise would really be on an increasing basis. But when we're Q4 heavy as far as adding new programs to the platform without any capital raise, then it pushes that number down. But on the next slide, ultimately, this is just a high level from our industry report, 12/31/2019, which just kind of shows the initial breakout of those programs, the target raise, both on those that we have coverage on, new coverage in that particular month. So at the top, just as an example, you can see we added 6 1031 exchanges in the month of December, whereas year to date, so through 12/31/2019, we actually added 99 total 1031 coverage, 1031s. At that year end, 12/31/2019, that first column shows that we had 68 open, currently active programs at 12/31/2019. And then you can see to the right, ultimately, well, what does that mean year over year? We're up, call it 20% year over year as far as total number of funds. And then you look at aggregate, both on a monthly, December, $370 million in aggregate target raise, and then year was just over $3.6 billion in target raise in the 1031 exchanges added in 2019, which was a 44% increase year over year. And ultimately, that applies to all the rest of those particular sections there. I certainly won't touch on each of them, but you can get a pretty good idea of where it was. The outlier kind of towards the bottom you'll see is our other real estate category was significantly down, but opportunity zones were significantly above, which in that opportunity zones actually all of the other real estate category shifted to the opportunity zone category. And if you were to add those together year over year, we'd actually be above. But because the category split, it looks a little bit different on the screen. Next slide, ultimately, is going to kind of some high-level bullet point. So 200 funds, give or take, added to our coverage in 2019. I think something that's important to note here that you won't see in our industry report is there are also restricted deals. So if there's like a broker dealer or an RIA has a deal that's very specific to them, they're the only ones that are selling it or using it with their clients. That's something that would not flow through to this report. You wouldn't be able to see it in the platform. And you could, between 5 and 10%, usually on top of the total number of programs you see, would be in addition that we would have it from a restricted program perspective. So that tells you, we have between another 10 to 20 funds that we added to our platform just in 2019 that fit within that category. We had 158 funds closed out. So if you remember that a couple of slides back, that net growth in open fund coverage in the platform from a private placement perspective, that's knowing that we also closed out 158 funds from the platform. And of those 158 funds, 85%, they raised 85% of their target raise. We currently cover at year end 179 funds, which represents just under $12 billion in target raise, and a reported raise just over $8 billion or fund 73 million, ranges from very small 3 million to upwards of $1 billion. 2020, obviously it's early in January. We've already added 14 new funds to the platform. New coverage in January. We have another 8 in the queue. And that really jives kind of if we're comparing January 2020 to 2019. The other thing we see a little bit of an uptick in 506C, the general solicitation side. We had 16 of them in 2018, 23 in 2019. A lot of DSTs fit in that category, but we also had Opportunity Zone as well as an LLC. So with that, what I want to do is I'm going to shift and I'm going to ask my counterpart, Laura Sexton, who really does a lot of the narrative write-ups and a lot of the external research here at AI Insight for this industry report. She's going to take the walk through each of these individual categories. So Laura?
Great. Yeah, thanks, Mike. Hello, everyone. Thanks again for joining us today. And yeah, I'll start kind of going through some of the individual categories that Mike touched on a little bit there. And I'm going to start with 1031 exchanges, which, as Mike said, are definitely continuing to expand. 2019 was actually a record year in terms of both the number of offerings we saw and the capital raise targets. We added 99 new funds in 2019, almost got to 100, so we'll see what happens this year. But we added 99 new funds in 2019, looking to raise an aggregate of $3.6 billion. The funds that we saw that were added to our platform were all DSTs. And in fact, all were DSTs in 2019. There were 25 separate sponsors, and the top sponsor in 1031s represented just under 20% of the total raise. For the DST sector, 78 1031s closed to new investors in 2019, and those funds that closed reported that they raised approximately 98% of their target, which is pretty typical for 1031s, actually. They usually tend to raise what they kind of get pretty close to the target on what they raise. So a couple things I listened to, and I don't know if anybody out there listened to this, but I listened to the Mountain Dell 1031 update call last week, which was really interesting. I actually had Keith Lampy of Inland on the call, and he was saying how they've seen a lot of full cycle activity, so funds kind of selling assets and closing out altogether, over $1 billion in full cycle activity, which might be driving some of the expansion in the industry. Of course, just continued high real estate prices is contributing to it also, but this full cycle activity with earlier funds kind of closing out is another thing that's been driving it. But another interesting point he actually talked about that I thought was interesting was the reinvestment in new 1031s and the percentage of dollars reinvested when a fund goes full cycle. So what percentage of dollars goes from an existing 1031 into a new one? And it's actually not that high. He said it's just over 50%. It's definitely lower than what I thought, but actually it makes sense. What Keith said is that really it's because of the step up in basis for heirs, that tax aspect of 1031 that actually works. So you naturally wouldn't have as much reinvestment and really wouldn't expect it and wouldn't want to if it's working right with that step up. But nonetheless, definitely, a very big year, a full cycle year and continued high real estate prices, so a big year for 1031s. Some of the other trends in 1031s, multifamily was the largest sector represented for the year, although most of the sectors were represented through the year. But we did see a lot of new multifamily properties with master leases in place. There were some new entrants with kind of more unique assets, a few retail funds, which we haven't seen much of in a while. In terms of kind of some of the ratios, average year one cash-on-cash returns were about 5.32%, about 5 basis points higher than 2018, so about the same. Average LTVs on new funds was 60.41%, about 5% lower than last year's offerings. A few other trends, and in terms of our current coverage, we currently have 70 open 1031s on our platform as of today, with an aggregate reported target raise of $2.6 billion and a reported raise of $1.5 billion, so that leaves a little over $1 billion in kind of available equity. For the funds we cover today, the average upfront selling commission is 5.83%, ranging from about 5 to 6.5%. Average net proceeds before acquisition fees is 90.04, ranging from 83.5 to 91.5. And the average liquidation fee is 3.07%, ranging from 1.5 all the way up to 5. So obviously you can see more details on fees in each of the funds program summary. And you can compare fees in the program fee and expense report. These are just some of the averages that we're seeing. So the industry seems like it's kind of on a similar trajectory this year. We've added 8 new DSTs in January, and we have 3 more coming soon. The industry is also kind of being buoyed, I think, by new sponsors entering the space, including Jones Lang LaSalle. Griffin's back in. Real estate pricing remains pretty high. So we kind of anticipate continued growth in this space. So now we're going to move on and talk about opportunity zone funds, which is where I think some of the capital has shifted, as Mike said, from the LLC LP space. And before I talk about our coverage here, I think it's important to discuss the bigger picture of opportunity zones in general, and a few things happening. And first is that the final date to have invested in an opportunity zone fund to receive the highest potential tax benefit has already passed. So that was December 31st, 2019, of course. So after this date, the 15% step up in basis after the 7-year hold goes away, as it's no longer possible to achieve the 7-year hold period prior to the end of 2026. The maximum step up now will be 10%, which is still good. It's just a little less of an incentive. But there was important guidance issued in December around opportunity zone funds, which addressed two big topics. And one is that QOZ funds, qualified opportunity zone funds, can sell individual assets in a portfolio without creating a taxable event and without losing the qualified opportunity zone tax benefit in its entirety. So that's a big clarification. And the other allows for the substantial improvement threshold to apply to each to apply to an entire QOZ property in the aggregate, rather than the original guidance, which applied to each building on a QOZ property. So if you owned a multifamily property on a lot and wanted to add another, you'd have to continue to substantially improve the existing building, even though you were adding a new one. So now a QOZ fund can add a new building, and that qualifies as substantial improvement. So I think these 2 points of clarification help the category. We'll see this year, even though the tax benefits are maybe a little bit less attractive. But here's kind of a little update in terms of what we've seen. Obviously new in 2019, but we saw 18 new funds added to our coverage in 2019 for a total of $2.4 billion in aggregate raise. One was added in 2020, and there's another one in the queue. There was one large energy-focused fund in 2019. That was the only non-real estate fund. The other 17 were real estate focused. 3 opportunity zone funds closed in 2019, reporting that they had raised approximately 93% of their target. We currently cover 15 funds that are raising capital, that are still out there raising capital, and they've reported an aggregate capital raise of $669.2 million, or approximately 37% of their target raise. A couple other little stats on the ones that we've seen. Target range is definitely it's a pretty wide range, ranging from $6.4 million all the way to $500 million. Geographic focus ranges from very specific, you're seeing very specific deals on a very specific lot in a specific place, to very broad. And same thing with sector focus, from the smaller funds kind of typically investing in a specified asset, and the larger funds looking to invest in a range of assets in the U.S. So we'll see what happens in the category in 2020, whether the updated guidance encourages more participation. Should be an interesting one to watch for 2020. So now we'll switch back and talk about the non-1031 space. So this is kind of more the private real estate LLCs and limited partnerships. And this category had a banner year in 2018, definitely ramped up more in recent months this year, but ended 2019 down in terms of both new fund formation and target raise. Again, that kind of having to do with some of those funds shifting over to opportunity zone funds. But the non-1031 real estate funds that were added to our coverage in 2019 were smaller than in private years. That's one of the things that we've seen. The total raise was down nearly 44%, while the number of funds was only down about 5%. So again, maybe attributed to that probably contributed to that qualified opportunity zone fund, which has absorbed some of the decrease in the category. So in terms of kind of the trends here, new fund formations in 2019 were relatively diverse, with all the primary sectors represented. Interesting, there were 5 large mortgage funds, so that ended up being the dominant sector in terms of the target raise, just because of how big they were. But you had multifamily, hospitality, and seniors housing funds that were also well represented during the year. So we added 41 funds to our coverage in 2019, offered by 33 separate sponsors. Definitely no dominant sponsor in this category. Quite a few sponsors with no major dominant sponsor here. The average target raise in 2019 within this category was $57.7 million, ranging from very small, specific targeted fund looking to raise $3.4 million up to $500 million for one of the larger mortgage funds. During 2019, 33 non-1031 real estate private placements closed to new investors, reporting an average raise of 55% of their target, which is relatively low, although we did have some funds in this category not reporting raise information, so it might be a little off in terms of what they actually ended up reporting for their final raise. In terms of what we currently cover, we have 58 non-1031 real estate private placements open, with an aggregate raise of $6 billion and an aggregate reported raise of $1.5 billion as of now, or 25% of target. Again, those are ones that are currently open, some of them relatively new, so that's the current reported raise is 25% of target. And actually, we've seen some activity here in this space in January. So, maybe off to a better 2020. I can't believe it's 2020. We've added 5 to our coverage here in 2020 so far. So that was way better than the 2 we added in December. So that's it for the non-1031 strategy. So we're going to kind of switch and talk about some of the other strategies that we cover in private placements. And the first one we'll talk about is energy, which was up just a little in 2019. We added 10 new funds to our coverage in 2019, and 9 actually closed during the year, reporting that they raised 52% of their target, although kind of similar to the real estate funds, 2 larger funds didn't report a raise. In terms of current coverage in energy, we cover 7 energy funds raising capital with an aggregate target raise of $313 million in aggregate, reported raise of 43.4, or 14% of target. Another area, we wanted to share some of the average fee information here. Again, you can see all the specifics in our reports, but in terms of averages for the energy funds, the average upfront selling commissions are 7%. That net proceeds before acquisition fees, the average is 88.38, kind of ranging from the mid-80s to 92%, and revenue sharing is typically above an average hurdle of 28.33%, ranging from 15% to 50%. So definitely kind of interesting times for energy. I mean, crude oil pricing was volatile through 2019, so it can be very volatile, but certainly volatile in 2019, more so than in other years. It actually ended up 17% for the year. Certainly continued volatility in 2020. Some of the kind of things going on in the globe early in the year caused it to increase a little bit. It's fallen back a little now, but what's interesting here is that I think the talk around energy is that $100 a barrel pricing may not be seen for some time. Actually, we kind of hope it's not seen for some time, but many anticipate pricing to top about $70 a barrel and kind of remain there for the foreseeable future. And in terms of what the impact on the private placement segment is that the industry's definitely slowed significantly since the oil crash in 2014 in terms of new funds and sponsors involved in the industry. And it really hasn't picked up since then. And in fact, the report that Mike mentioned earlier, the SEC's private fund statistics report, showed that the percentage of private fund dollars invested in the oil and gas extraction industry, which is the energy component of that report, is roughly half of what it was prior to the oil crash. So certainly mirrored in our coverage with quite a bit less in terms of coverage and funds added. But we'll kind of see what happens as oil pricing recovers or kind of continues its slow recovery here. So another area that we cover are the conservation programs. Just a few trends here. We added 23 new funds in 2019 with an aggregate target raise of $24.6 million. Very slow start to this category. This is usually a back-ended sort of category, but it was slow and negative year over year all the way up until about October. But despite this, the category actually finished out the year pretty close to its 2018 levels. So, again, with its tax focused, this segment typically ramps up later in the year. 2019 was certainly no exception, probably even more so back-ended than in prior years. 17 of the 23 funds we added were added in Q4. We don't have any of the funds in the queue right now, but obviously that's kind of to be expected with the category. Next is preferred offerings. Another area that's a little slower than in the past, although it's never been a big area of coverage for us. We added 3 new funds in 2019. And in terms of our current coverage, we cover 4 private preferred funds with an aggregate target raise of $330 million and a reported raise of about 25% of their target. And we actually cover 5 public preferred programs. And we did add 1 new private preferred fund in January, so a little bit of growth here at the beginning of the year for this category. And then last but not least, private equity and debt trends. So we added 6 new private notes funds in 2019, which was 1 more than 2018. But what's interesting here is that in 2019, the funds were significantly smaller in terms of their target raise than in 2018. The aggregate target raise of the funds added last year was $110 million, which was down over 93% from the prior year's target. 5 private equity or debt funds closed in 2019. Funds, many of them, but when they close out, it looks like they tend to raise pretty much what they're targeting. In terms of our current coverage, we cover 11 private equity or debt funds that are currently raising capital. So, that's it, I guess, for our comments and for our recap of what happened in the private placement sector in 2019. Like Mike said earlier, all of our private placement reports and more are available on AI Insight in the industry reports section. But for now, I'll hand it over to Jen, and thank you all very much for joining us today.
Thanks so much, Laura. Thank you, everyone, for joining the call today and taking time out of your schedule. Watch out in your email for our monthly event update, or you can visit AIinsight.com to register for our webinars. Also, please reach out to AI Insight customer care team with any questions. Thanks so much and have a great evening.